Hi, everyone. This is Nathan Jennison of the Mortgage Architects. I'm going to talk to you today about self-employed and filing taxes, something I'm really excited about, honestly. So, all right, if you're self-employed and you're looking to get a mortgage loan, whether that be to purchase a home or refinance within the next 2 years, then it's really important that you know this information. Number one, this is what you need to know. When you're filing your taxes this year, make sure to send us your tax drafts prior to actually finalizing those. What we're going to do is we're going to compare them. We're going to make recommendations and make sure that you are in a good spot in terms of being able to get your loan in the near future. Why is this important? Well, most of us know that W-2 employees have an easier time getting income qualified to be able to get a residential mortgage loan because their income is considered to be stable and easily calculatable. Now, in terms of being self-employed, there's actually most people don't realize that there's a huge advantage to being self-employed in terms of your income. So one, you can make decisions that make your business flourish. You can work really hard at it, and thus you can get higher income and be able to be approved to purchase a home at a higher purchase price. And that's really, really key. Another one, though, is that we tend to be really aggressive in writing off as much as we can in terms of business expenses because self-employed people, myself included, we don't like to pay taxes. And so we want to limit our liability as much as possible. We also hire CPAs that we judge to be good or bad based upon their ability to make our income vanish and thus pay less taxes. Well, the problem is that in both those situations, what we're doing is we are reducing our tax liability, but we are also reducing our ability to purchase a home or get a mortgage loan. We can only use income that's qualified that we have paid taxes on in terms of carrying a mortgage loan. And so what we want to do is make sure that you're paying enough in taxes to be able to have enough income to get the loan that you want. Now, when you send us those drafts, what we're going to do is we're going to send them through a worksheet that looks something like this. Now, in this case, we're looking at a hypothetical business, and in 2022, they made $150,000, and in 2023, they made $120,000. Well, at first glance, that's really bad because this is what's considered to be a falling income situation. It makes it look like the business isn't stable and that ultimately an underwriter would not accept this income. Well, what we want to show you is this. We keep going down. We're going to see, okay, they paid $35,000 of wages as opposed to $32,000, which is, doesn't make much of a difference. But further down, this line for depreciation is really, really key. In 2022, they paid $5,000 in depreciation, and in 2023, they're paying $45,000. Well, first off, what is depreciation? It means that it is essentially a loss, and it's basically items that the business owns has fallen in value as time has gone on. So a key example of this would be a vehicle. You have a business vehicle. As the years progress, that business vehicle is going to be worth less and less. A 2020 is not as worth as much as a 2024. Now, in this case, that depreciation, the IRS sees that as a loss, and you're not paying taxes on that amount of money. However, in terms of a residential mortgage loan, that money is not seen as a loss, and we actually can add that back into income. And so when we take this all the way on down to the bottom of the worksheet to look at approvable income, we'll see that 2022 had $187,000, whereas 2023 has $200,000 of approvable income. Now, in business with self-employed income, we typically are taking 2 years' income and we are averaging it. And so in this case, we add 200 to 187, and then we divide that by 24, and we get a approvable income of $16,125, which is then used to carry that residential mortgage loan. That's what we're using for qualifying purposes. Now, if you have had a business that has been around for 5 or more years, and we're doing a conventional loan, in that circumstance, we may be able to use 1 year's of tax returns, and that gives us even greater flexibility. All of this to say, when you do your taxes, make sure to send us your tax drafts so that we can review them and make recommendations and make sure that you're setting yourself up for success. That's really, really key. As always, please reach out with any questions. Happy to consider your situation, and we'll do everything we can for you. We'll talk to you soon. In the meantime, our licensure information is going to be posted right after this. Feel free